Hey everyone, I'm Barry.
And I'm Steve. I'm excited to jump into another topic here with Barry. We're doing these short webinars to give you guys some really keen insight into detailed topics. Today's topic is pretty exciting because we are talking about lump sums. And of course, everybody listening probably knows you can put your money in different places. You have the option for a traditional bank, or you have limited returns and potential exposure to creditors. I just want to mention that. And versus some of these other products that we're talking about, assets, you have asset protection. You also have guaranteed growth, and we're going to touch on that. So, Barry, thinking about lump sums, what options do people have?
Yeah, awesome. And we're specifically talking today, Steve, about a whole life insurance policy. The option is you can do a single pay where you make one premium payment and never make another premium payment thereafter, versus a lump sum where you do put in a large amount first year, but year two forward, you reduce to the very minimum and keep the money growing in both situations.
So what you're saying is if someone's got just a lump sum account sitting in a bank, these are some options where they can take that money, throw it into a policy of some kind, or an asset. We call it, an asset when you're talking high cash value. And you're showing basically us how to do that, or what some options for that are, correct?
Yeah, think about it. You might be out there with a bank account earning 1% or less than 1%. You might have CDs that are earning low returns. And the policy, because it's a high cash value whole life design, you actually are able to get a better return and you get a death benefit. You don't get a death benefit in your bank account or in your CD or other places like a 401k or IRA. So yeah, we're going to get into the details of those exact numbers.
And as an attorney, asset protection, I'm always thinking, if somebody's sued for whatever. And I just talked to a business owner yesterday that was worried about this. And so you also get that. In most states, you're going to have statutory asset protection, at least at some level of the cash value.
That's right. Most states, we say, are protected from creditors, lawsuits, even bankruptcy. You do need to check your state specifically, but much better than the money just sitting in a bank account subject to who knows what.
Correct.
So let's use 110,000 going into the single pay and 110,000 going into the lump sum. Here's the difference. In the single pay policy, this is the first year, but in the second year, the premium is zero. In the lump sum design, this is the first year, and the second year is around 10%. I'm just going to leave it at that for now, and then we'll get into the real numbers. But Steve, here's the other big difference that people need to be aware of. In a single pay policy, this money and growth is growing tax deferred.
All right, let me stop you for a second, Barry. So if somebody's watching and they think, well, I've got $1 million, is there a limit on how much I can put in? Or maybe someone's got $10,000 on the flip side.
Good point.
Any thought for anybody considering this?
Yep. We are going to have to get them approved based on their age, their health, their overall income. But absolutely, we can get $2 million, $3 million, $5 million, $10 million into these policies if someone wants to get really aggressive.
Gotcha. And vice versa. If you got 10,000, you can work out a plan for that as well.
That's correct.
Lump sums.
In the lump sum policy, the IRS says that if you fund a policy for at least 7 years, so we're going to pop this one in here, 7 years or longer, you now grow the money tax-free. There are some other minor caveats, but we teach people how to grow money tax-free. So you could decide if you want a single pay policy and you don't care about tax deferral, because you don't want to make another premium payment, go that direction. But if you want tax-free growth on your money and you don't mind continuing payments for at least 7 years, then you would consider the lump sum option.
Gotcha. And that 7 years is really what we call the MEC limit, which you guys getting into this initially need to know that's a factor in designing the right kind of high cash value product policy.
Exactly. Well, Steve, let's get into the numbers.
Yep.
We're going to first look at the single pay. And
Feed me, Barry. Feed me.
That's right. We've got the single pay 110,000. You see that coming into the policy. What immediately happens day one, when this policy is started, they turn this 110,000 into a $254,000 death benefit. So they've just increased their estate from 110 to 254 just by the sheer fact of having the policy, Steve.
Bam.
Bam, exactly. And look at this. Every year, as time goes on, that death benefit is growing. So the estate is getting larger and larger. And here's what's cool. Even though a single pay policy, the cash value is tax deferred, the death benefit is tax free. So if they never use the money, this death benefit's going to pass to their beneficiaries or their estate tax free.
Right. So this needs to kind of sink in for folks, right? Permanent death benefit. So they just spent that money, 110,000 in this case, and that's a permanent death benefit, permanent life insurance.
No expiration. This isn't a term insurance policy that's going to go away.
Mm-hmm.
So whether they pass away at 67 or 107, there's always a permanent death benefit here. And we're doing this on a 50-year-old. You know, if a healthy 50-year-old today is going to live to about 87 or 90, well, check this out, 413,000.
Yeah. So, you know, for all of the comments and thoughts about life insurance that are out there, this is one hard fact that you give a lump sum to your preferred company, and they're going to give you, you know, a large return on that alone, not even getting into yet the lifetime benefits of that cash.
That's right. So year one, this 50-year-old puts in the 110,000. What's available? 93,983 of total cash value. And every year, the cash value is also growing. So by the time they get to year 5, Steve, they now have equalized the 110 that they've put in is now there in cash value. And every year thereafter, $4,000 worth of growth, $5,000 worth of growth, $6,000 worth of growth. It's always increasing because they're earning a guaranteed rate of return, and the insurance companies are paying them a dividend that's reinvested back into cash value.
So Barry, is it fair to say that after 5 years, they haven't spent anything? I mean, how would they look at that? I mean, it's basically paid, they're back to, they just got their death benefit and they've got their cash, and they haven't spent anything on the policy at that point, or what's accurate?
Yeah, that's correct. So they have all their cash value back in year 5, and their death benefit is $263,000. So if they wanted to cancel the policy and get all their money back, they could. Obviously, we want to encourage them to let it grow because the asset is growing guaranteed every year.
Mm-hmm. And guys, for this particular strategy and with mutual high cash value life, there's no guesswork in it, right, Barry? Other than maybe people ask, what am I going to get for dividends and this kind of thing? That's another webinar, but really there's no guesswork. There's no what ifs. There's no, the market has to perform this way or that. Correct? I mean, this is guaranteed contractual stuff.
Yep. This is your sleep well, safe bucket of money.
I think that's key because you're talking about people's maybe savings account, whatever. So that's something that you want to keep that safe bucket.
Yep. So let's now make the comparison to the lump sum design. 50-year-old, we're showing the same 110,000 going in year 1. Death benefit, 1.5 million. Why is it 1.5 million? The other one was 250. I mean, what's going on here? Well, in order for the policy not to become a MEC, the death benefit has to be sufficiently high so that the policy cash value grows tax-free. It's simply an IRS guideline that says you can't MEC a policy, and we have to have sufficient death benefit in order to do that. But Steve, here we have this person that turned their 110,000 estate value into 1.5 million. Day one.
Yeah, and you always hear that, if you guys are doing any research on this, you're going to hear different experts, us included. There are always those people that, maybe we recommended that they get some permanent life insurance. They didn't do it. Maybe they pass away a few years later. So these are very critical, important things, right? To be able to leverage 110,000 like this is significant.
Exactly. And on this lump sum comparison, remember, if done correctly and you fund a premium at least 7 years, all the cash value is tax free. So in year one, when the 110,000 goes in, net cash value is 104, which is higher than what we saw in the single pay policy. But you do have to pay a premium thereafter. In this case, it's just under 10%, about $9,300 a year. Cash value is still growing, but notice around the fourth year, you break even. You put in 137 at that point, you're sitting on 139. You've more than made your money back and then some. So you only have to continue the 9,300 for 7 years. If you want to stop funding thereafter, you can. We're going to encourage you to keep going if you're either still working or you have cash or assets that can pay the premium. And here's why. In year 8, there is a term insurance rider that drops off the policy. We're not going to get into the details of that today. There's more webinars we've done on that. But the minimum premium starting year 8 is about $8,000. Well, check this out. Your cash value grows from 196 to 212.
So things start to get good in year 8 and 9 is what you're saying, Barry.
They get really good. There's a $16,000 gain on your $8,000 premium. And every year, Steve, it just gets better and better and better. So again, if you've got the cash flow, if you're still working, you've got investments that can make the $8,000 premium. You do want to keep it going longer than 7 years if you can. Fund it as long as possible, because that is simply going to give you more cash value in the future.
So if anybody's listening that's heard buy term and invest the difference, I think we just did, didn't we? We bought some term, we blended it in with the policy, we powered up that death benefit for several years and let that policy start rolling, and then look what happens, right?
That's right. Steve, so if we look at the scenario here, and this person lives to 87 or 90, death benefit at that point, $917,000, $998,000, so about $1 million of tax-free death benefit, and there's all this cash value along the way. So again, this lump sum, if done correctly and funded for at least 7 years, is a non-MEC policy. Whereas the single pay, it immediately is a MEC, and that is why it's growing tax deferred.
So tax deferred versus tax free. There might be people listening that think, MECs are always terrible. They're to be avoided at all costs. Not really. You're still getting tax deferral, which is what the claim to fame for other kinds of, qualified accounts, right? Or you get your full 7702. If you haven't heard that term, that just means life insurance tax treatment. Well, it doesn't just mean that, but it kind of goes in that direction, right? You get tax-free growth. So pretty interesting. And you've got a few choices.
That's right. And you bring up a good point. Someone that has a bank account, a 401k, an IRA, or even CDs, they're going to have to pay the tax. So we're not saying a MEC policy is a bad thing. What we are saying is you're probably going to like it a lot better than those other types of investments that we just talked about. So to grow your money guaranteed, to have access to liquid cash, and really enhance your overall estate and your portfolio, you can choose single pay or a lump sum. We look forward to working with you. Click the button below. Look at your own numbers. And Steve, we hope to talk with folks soon.
All right. Thanks, Barry. Great stuff. Guys, look at our other webinars. If you're continuing to do your research, schedule a one-to-one when you're ready. And thanks for joining us.